Exploring decentralized finance, DeFi, platforms for wealth building. Decentralized finance, DeFi, has emerged as one of the most transformative innovations in the world of finance, shifting the landscape from centralized banking systems to open, peer-to-peer networks powered by blockchain technology. DeFi offers individuals the opportunity to engage in financial activities such as lending, borrowing, trading, investing, and earning interest without relying on traditional intermediaries like banks, insurance companies, or brokers. Instead, DeFi platforms use smart contracts and decentralized applications, DApps, to automate and facilitate financial transactions, enabling users to have full control over their assets. This video explores how DeFi platforms are opening new avenues for wealth building and democratizing access to financial services, and why they are rapidly gaining attention from individuals, investors, and financial institutions. At the heart of the DeFi revolution is the concept of decentralization. In traditional finance, intermediaries play a central role in ensuring that financial transactions are conducted securely and efficiently. Banks, for example, are responsible for managing deposits, loans, and payments, while stock exchanges and brokers facilitate the buying and selling of securities. These intermediaries typically charge fees for their services and can impose restrictions on who has access to financial products. DeFi, by contrast, operates on blockchain networks, where transactions are recorded on a public ledger accessible to anyone with an internet connection. By removing intermediaries, DeFi platforms offer more transparency, lower fees, and faster transaction times. One of the most exciting aspects of DeFi is its ability to offer inclusive financial products that are accessible to anyone, regardless of their geographical location or financial background. Traditional banking systems often exclude individuals from underserved or unbanked regions, where access to banking services can be limited or expensive. DeFi platforms break down these barriers by enabling anyone with a smartphone or internet connection to participate in financial markets. Users do not need to meet strict credit requirements or navigate complex paperwork to access financial services. As a result, DeFi has the potential to bring financial inclusion to millions of people around the world who have been excluded from the traditional banking system. Lending and borrowing represent one of the most popular and impactful use cases of DeFi platforms. In the traditional banking system, obtaining a loan often requires an individual to go through a lengthy approval process, including a credit check, application fees, and waiting periods. DeFi lending platforms, on the other hand, enable individuals to borrow and lend cryptocurrencies directly with one another without the need for banks or other financial intermediaries. Platforms like Aave, Compound, and MakerDAO allow users to deposit digital assets into liquidity pools, which other users can then borrow. Lenders earn interest on their deposits, while borrowers can access loans quickly by offering collateral in the form of digital assets like Ethereum or stablecoins. The key advantage of DeFi lending is the ability for users to earn interest rates that are often higher than those available in traditional savings accounts or fixed deposits. Interest rates on DeFi platforms are typically determined by supply and demand within the platform's liquidity pools, meaning that borrowers may have to pay higher interest rates during times of high demand, while lenders can benefit from higher returns. In contrast, traditional banks often offer lower interest rates on savings accounts due to the centralized nature of their operations. By participating in DeFi lending platforms, users can optimize their wealth building potential by earning interest in a decentralized and transparent manner. Borrowers, on the other hand, benefit from DeFi lending platforms by accessing loans without the need for a credit score or lengthy application process. The collateralization mechanism, where borrowers must lock up a certain amount of assets to secure a loan, reduces the risk for lenders while allowing borrowers to access funds with fewer restrictions. For example, if someone wishes to borrow USDT, a stablecoin, they can deposit a certain amount of cryptocurrency like Ether or Bitcoin as collateral. As long as the value of the collateral remains above a certain threshold, the loan can be taken out without the need for a traditional credit check. This opens up borrowing opportunities for individuals who may have limited access to traditional credit facilities. Another key feature of DeFi platforms is the ability to trade and exchange cryptocurrencies on decentralized exchanges, DEXs, without the need for intermediaries like centralized exchanges. Popular DEXs such as Uniswap, SushiSwap, and PancakeSwap allow users to swap one cryptocurrency for another directly, using liquidity pools rather than relying on an order book. This is made possible by the use of automated market makers, AMMs, which automatically determine the price of assets based on the supply and demand within the liquidity pool. Because these platforms are decentralized, users retain full control of their assets at all times and can trade without entrusting their funds to a third party. Decentralized exchanges also offer the potential for wealth building through liquidity provision. On platforms like Uniswap, liquidity providers, LPs, can earn fees by depositing pairs of cryptocurrencies into a liquidity pool. These fees are paid by traders who swap assets using the pool, and LPs receive a portion of the trading fees proportional to their share of the liquidity pool. The return on investment for liquidity providers can be quite attractive, especially during times of high trading volume. However, liquidity provision also comes with risks, such as impermanent loss, which occurs when the value of the assets in the pool changes relative to one another. Nevertheless, for many, the potential for passive income through liquidity provision has become a compelling way to grow wealth in the DeFi space. Staking is another mechanism through which DeFi platforms allow users to build wealth. Staking involves locking up cryptocurrency assets in a network to support its operations, such as validating transactions or securing the network. In return for staking their assets, users are rewarded with additional tokens or interest payments. Many DeFi protocols, such as Ethereum 2.0, the upgraded version of the Ethereum network, and Cardano, enable staking for network security and governance purposes. Through staking, users can earn rewards that compound over time, contributing to long-term wealth accumulation. Staking has gained popularity because it provides a way for cryptocurrency holders to earn passive income on their holdings, without having to sell or actively trade their assets. Yield farming, or liquidity mining, is another wealth-building opportunity within DeFi platforms. Yield farming involves using assets to provide liquidity to decentralized protocols in exchange for rewards in the form of governance tokens or additional cryptocurrency. These rewards can then be reinvested to generate further returns. Yield farming has grown exponentially in popularity due to the high returns that can be generated, especially when new projects or tokens are launched. However, yield farming can be complex and comes with risks, including smart contract vulnerabilities, market volatility, and impermanent loss. For those who are willing to take on higher risks, yield farming can be a way to maximize potential gains. One of the major benefits of DeFi platforms is their openness and transparency. Unlike traditional financial systems, where processes are often opaque and decisions are made behind closed doors, DeFi platforms are built on open-source protocols that anyone can access and audit. Transactions are recorded on a public blockchain, meaning that users can verify the activity on the platform in real time. This transparency not only fosters trust within the DeFi community but also ensures that the platform's operations are transparent, secure, and auditable. The openness of DeFi platforms has led to the development of decentralized governance models, where users can vote on decisions related to the platform's future, such as changes to protocols or fee structures. This community-driven approach has empowered users to have a say in the direction of DeFi projects, contributing to a more democratic and decentralized financial ecosystem. However, while the potential of DeFi is vast, it is important to acknowledge that there are risks involved. DeFi platforms are still relatively new and, as with any emerging technology, there are concerns around security vulnerabilities, regulatory uncertainty, and the potential for fraud or hacking. DeFi protocols are powered by smart contracts, which are susceptible to coding errors or exploits, as evidenced by several high-profile hacks and exploits in the DeFi space. Additionally, the lack of regulatory oversight in many jurisdictions raises questions about how DeFi platforms will be treated under existing financial laws and whether they will be subject to new regulations in the future. As the DeFi space continues to evolve, users must exercise caution and conduct thorough research before participating in any platform.